It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And here's the man himself, the Mike in Ask Mike Mondays, the guy who's the governor of real estate in the great state of Texas, Mr. Michael Becker. How are you, Michael?
Hey, Paul, doing pretty good. How are you doing today?
Not doing too bad. You know, it's the day before the election, so everybody who's listening to this already kind of knows what happened at the election. So we're doing this. Yeah, hopefully. I was around when they were figuring that out in Florida many moons ago. So hopefully they figured out who new president's going to be. But when we make comments today, we're doing it pre-election. So we're excited about that. Mike, what's going on in your world? What's going on with you?
Oh, just been staying busy. We sold a property about a little less than a week ago as we talk right now. So it was a big win. It was in escrow for a long period of time. And we bought a property at the end of about a month ago as we talk here and are actively doing a equity raise kind of post-closing. So it's been a little different for us and it's going well. So it's been, buying, been selling, and I feel like I got my kind of finger on the pulse of the market. So happy to talk about pretty much anything you want to talk about, Paul.
Well, today I really wanted to talk about, you had a document in your business plan that I want to talk a little bit about, is that when people raise money on the apartment side, we do it in syndications. And with the syndication, it's a group of people that get together with a common purpose to try to figure out how they can buy a piece of real estate. And I use my airplane analogy is that people in the front of the airplane are kind of the sponsors. They're the ones that are the captains of the airplane. They're making decisions about when to take off, where they're going, how many passengers are going to be in the back, how much money they got to raise. And then the people in the back of the airplane, that's like you and I, we're the limited partners in the deal. We're asking, when is this plane landing? And can I get a Coke and maybe some peanuts? So we don't make a material, we make a material investment, but we have no material decisions because we let the guys in the front of the airplane, the guys and girls in the front of the airplane make decisions about what's going on with this flight or with this opportunity to do a syndication. You've got to follow rules pretty closely. And so one of the things when you raise money, you have to kind of give a business plan about what's going on out there, what you see as a captain. We're going to maybe have some turbulence. This is when we expect to land. This is when we think it's going to happen. So in one of your documents that you had a phrase called generational buying opportunity. Generational buying opportunity. I kind of want to walk through that real quickly. Because my question really is today is, what is a generational buying opportunity, and can people who are thinking about raising money in the future or thinking about investing, can they kind of use some of your words of wisdom about what a generational buying opportunity is? So let's kind of talk a little bit. I'm going to kind of read this a little bit, and I just want to get some of your feedback. In SPI's opinion, and you're with SPI, this is a generational opportunity to buy a multifamily, arguing the best moment since 2011 through 2013 to purchase high quality apartments for several reasons. It's clear to us, and again, let me go through it. One, multifamily valuations on average are down between 20 and 35%, depending on the quality and location of the asset from the peak of first quarter of 2022. To be sure, the peak did get a little silly with a pro forma of year one cap rates in the threes in some cases, but nevertheless, values are substantially lower than the first quarter 2022 peak. Tell me a little bit about what that means, Michael. Can you give me some background?
Yeah, I also wrote this in the third quarter newsletter. And that's kind of where I got this from was that. So people that aren't on our list to get our newsletter, that's kind of was the article. But yeah, I mean, just the beginning Q1 of 2022 is kind of where the peak of the market was. And from that moment in time, valuations are off, roughly a third, 30%, give or take, depending on, quality of the location. So I think the newer, nicer, better located deals have held up better. The older, tougher, lesser located deals, the valuations have fallen even more from the peak. So I think it's just a moment in time to realize that, valuations are substantially lower than where they were. And, it's kind of like you want to go buy a suit, you want to buy one 35% off, or you want to pay full price. So it's seemingly on sale at this moment in time. So that's one of the things that's got us excited, that you buy deals at a material discount to the peak and the material discount to what the prior owner bought it for in a lot of cases today, Paul.
Can you just give me, a lot of people that were not in multifamily years and years ago, and I say years ago being about 3 or 4 years ago. So a lot of people don't understand about cap rates and about what a class A property was selling for, a B property, and a C property. What cap rates were they using?
Back, when I first started buying apartments, Paul, and bought our first one in 2013, so 11, almost 12 years ago now. It was, you could buy in Dallas-Fort Worth, which is where we started. You could buy a brand new Class A deal for around a 5 cap, which, be new construction. A B deal, which we'd call the 80s, generally speaking at that time, was about, 6 to 6.5% on the cap rate. And a C deal, which would be like 60s or 70s for kind of year of construction. Those traded between 8 to 8.5 cap. And then you kind of fast forward to the peak of Q1 2022, those cap rates were virtually on top of each other. What used to be maybe 300 basis points or 3%, 3 to 3.5% spread between the better product to the inferior product got to, within 0.5%, maybe in a lot of cases, certainly less than 1% spread. So the market kind of priced out the risk that is associated with a lot of these older, tougher deals. And the market just kind of priced that out as if it didn't exist. And that didn't make sense to us. And you heard, if anyone's been listening to podcasts for a while, you've heard me say this many, many times. It didn't make sense to pay the same or similar cap rate for something old that you could for something new. So we took the opportunity the last decade to kind of generally sell older property and buy newer property. Now that the valuations have fallen, the cap rates have widened out. So, your newer, nicer stuff is still trading around a 5 cap, Paul, but your 80 stuff is probably high 5s to 6 kind of on a cap rate, and your 70 stuff certainly has a 7 handle on it, if not a little higher in most cases. Some cases a little lower, but generally speaking, it's probably a 7 cap to clear or higher for your workforce housing. And now that there's a little bit more reward for that risk, it's starting to become a little bit more attractive in my mind to kind of go downstream and buy some older stuff, that's well located within reason. So, we're not trying to buy all old workforce housing stuff at this moment in time, but it's definitely a lot more attractive than it has been.
Let's go back to the generational buying opportunity. Point number 2, in our view, that's SPIs, specifically in Class A or A minus properties in DFW, we have bounced off the bottom in valuations. We pegged the bottom, happened in October 23, when the 10-year Treasury hit 5%. That was clearly the max pain point in the market, in conjunction with the Federal Reserve, who had not conveyed a pivot in their aggressive tightening cycle. What does that mean?
Yeah, I mean, that's when I think that was when kind of everyone threw their hands up and didn't want to buy. The volume, I'm sure you can speak, is probably not too dissimilar than kind of this moment ever since the Fed cut rates. The 10-year Treasury is up 60 basis points or so as we record this right now from mid-September, which is kind of the opposite of what a lot of people think were thinking was going to happen. But, people just there was some uncertainty. The rates were rising. At that moment in time, October 2023, the 10-year Treasury at 5%. You can watch CNBC and see some of those guys say, hey, maybe it hit 6, maybe hit 7% on a 10-year Treasury. And it really kind of gave a lot of uncertainty and a lot of pain in the marketplace. So there was a lot of paralysis, so not too many deals sold and traded. And then, as you got into November, December, the rates fell quite a bit and, ended below 4% on the 10-year at the end of 2023. So then that's kind of what happened. So I think that really was kind of the max pain point, in particular for like your Class A or your Class A minus deals. And then the market's been more robust and been a lot of activity and interest ever since then. So, with the risk of looking completely ridiculous here as soon as this thing comes out, it seems like recently we've seen, 60 or so basis points rise in the 10-year Treasury since the Fed cut. It seems like, to me, in my view, a lot of that was pricing in Trump getting elected. So we'll find out if he got elected or not here. And even if they have, it seems like we had a bad jobs report here last week. As we record this, there's probably another bad jobs report coming up. So it seems like maybe the 10-year Treasury might be a little bit overdone in my mind in the short run. And maybe it'll start drifting a little bit lower before you know it too long. I don't think we test 5% again. I think we'll probably kind of near a near-term peak, and hopefully we start going down from here. So that could look completely ridiculous as soon as this thing is posted. That's what it kind of feels like to me, that there's a little bit more stability. There's definitely more stability in today's market than there was, a little over 12 months ago.
Can we talk about big picture a little bit, about deliveries? I mean, a lot of builders in Texas that build apartment buildings have never found a property that they didn't want to build. So one of your points on this generational buying opportunity is that we are months away from a material drop in new apartment deliveries. It is virtually a mathematical certainty that new deliveries drop meaningfully in 2025 and remain lower for a couple of years at minimum. This should lead to upward pressure on rental rates due to less competitive and competition for tenants. Talk a little bit about that. What does that mean?
Yeah, I mean, we are at a 50-year high in deliveries. You have to go back to the 70s when all the apartment developers were building, apartments for all the baby boomers coming out of college and stuff like that. So we're at the highest delivery point since the 1970s, even higher than the 80s. So they're delivering a ton of multifamily units, and that really came out of the 2021 rental rate boom. When they dumped all that money on the marketplace, we saw, depending on the deal, upwards of 15 to 20% rental growth in 2021 and significant rental growth in 2022 as well. 2021 was unbelievable. We probably got about 5 years of rent growth in 1 year, which is amazing. I don't think we'll ever see that again in my lifetime, at least. And so what happened was all these developers that didn't build stuff kind of in 2020 with COVID, they raced, and interest rates were at zero and the Fed funds basically, and so got cheap money and built started a ton of units. So in Texas and the Sun Belt, most markets, it takes about 24 months, Paul, to build a garden product, which is like your 3-story walk up. It takes about 30 months to build a structured parking building, like your wrap construction. High rises might take a little longer, but most of either wrap or garden product. So, if you think back to also 2023, but you go back to March of 2023, First Republic Bank, Silicon Valley Bank both failed in March of 2023. And ever since that moment in time, it's been, nearly impossible to capitalize a deal with equity or get debt for new construction to build a multifamily project. And most markets across the country, certainly in Texas. So we've seen, meaningful slowdown in deliveries. And so if you kind of look at that moment in time, March of 2023, so as we record this, what is that, like 20 months or so ago? Is when you stopped seeing a lot of the starts. The starts stopped. So just kind of fast forward, you get somewhere between March and June of 2025. All these deals that have started have largely been delivered or on the ground, and there's not a whole lot behind it. And these deals take a little while to get from breaking ground to build, like I said, 24 to 30 months. So you can't just snap your fingers and deliver supply. And you can't start a project until you get a permit. And these permits also, that is, public record, and those permits are down meaningfully. So until we start seeing a big uptick in permits, there's not going to be deliveries that follow it, 2 to 2.5 years later. So once we kind of get into 2025, which is, less than 2 months as we record this away, really kind of, I'm pegging it, give or take June of 2025, Paul, is kind of when I think that's a major inflection point. Hopefully a little earlier, hopefully, maybe more like March or April, but certainly by June, I think there'll be a big inflection point, in particular in Dallas-Fort Worth, maybe a little later in, say, Austin, where they have even more supply being delivered. And I think that's when it kind of flips from, these headwinds that we've had as apartment owners go to tailwinds. And I think we start seeing rental rate growth. And I think that accelerates in 26 and 27 as, there's, further and further away from, new deliveries. So I think 26 and 27 are setting up to be 2 unbelievable years for rental rate growth for our industry. I don't think it hits 2021 levels, which is ridiculous, but if we're happy with, normal years, 3%, maybe we get 5 or 6% in those years, which would be very welcomed news for a lot of people probably listening to this podcast here.
So, I mean, these are all bullet points in a presentation that Mike put together under his business plan for when he was buying a property that I wanted to kind of pull out. So if you were thinking about trying to raise money for your own deal, or you were thinking about investing, you got to look at the kind of the big picture, what other guys in the cockpit are thinking about when they're talking to some of the limited partners that are bringing some of the cash to the transaction. I mean, this transaction is on its way to being completed right now. And so Mike's not opening up his to try to have you do it, but maybe the next one that you want to talk to SPI. What's the best way for people to get a hold of you, Mike, at SPI?
Yeah, I think the easiest way is just go to our website, which is www.spiadvisor.com. That's SPI like spy, advisor.com. There's a form you can fill out, get our quarterly newsletter, which this article originally was published in, or see future investment opportunities if that's of interest to you. And kind of a final point to the article, kind of what I wrapped up with is, and I think we're on the onset of a bull market. Like I said, I think 26 and 27 are setting up to be great years. I think the latter part of 25 will be better than the first part of 25, because we'll be that much further away from these deliveries, and no one's going to come in this business and wave the all clear flag or put up a mission accomplished banner going back to George Bush. I mean, but kind of looking forward, the institutions are back in a big way trying to buy deals. Seems like the Fed is cutting rates, treasuries are going to go up and down a little bit. It's not directly correlated on the long end of the curve exactly to what the short end of the curve is going to do, but directionally I think the rates are lower, certainly on the shorter end of the curve. And I think you see these institutions coming, and you're going to see material decline in deliveries that should be supportive of rental rate growth. So I think this is a great time to be buying, and by the time you're 9 months, you buy something today, 9 months from later, it's got a completely different environment than what it is right now. I think we're kind of at the tail end of winter, and spring is soon to be upon us, and we're trying to buy as much as we can, as I think that those that have the courage of their convictions to do deals now will be handsomely rewarded in 27, 28 when you go try to sell these deals, and should be for materially higher pricing. And right now you can buy new or newish construction at or below replacement cost, and that's usually historically a pretty good time to be buying these deals. And these moments in time don't stick around forever. So I think now there's a lot of things that makes me real excited and bullish after having a tough 24, 30 months. It's been a tough little stretch for our industry. And it seems like, again, spring is going to be here. It's not going to be perfect, straight line. There'll be some zigs and zags along the way. And, if you have some older legacy deals, there'll still be some things to work through. But, I think directionally we should start getting all these headwinds could start turning into tailwinds and incrementally improve, day in, day out is kind of what I expect to happen, Paul.
Again, Michael Becker with SPI. Can contact Michael and his group over at spiadvisory.com to just get on their list, to have them drip on you every once in a while to take a look and see what they're buying and see why they're doing it. You don't have to invest, but you want to just get as much information about what other apartment sponsors are talking about. And so you want to get into their database and kind of learn and be part of
learning, Paul. What's coming up? Do you have something coming up here in the near term for Old Capital?
So we have a lunch and learn coming up here in the Dallas area for people that are, whether they're brand new or they're investors or sponsors. November 14th, go to Old Capital Conference, and then sign up for our newsletter, and we'll get you some information about the Lunch and Learn. Again, it's going to be up in North Dallas. It's going to probably be 40 or 50 people there. If you show up, just a great opportunity to shake people's hands, get to know them, and then we'll talk a little bit about what our perspective is in multifamily. Again, we are an apartment financing group, so we finance a lot of apartments, 1 out of every 3 apartment buildings of Class B and C in the Dallas-Fort Worth area. So listen to our perspective of what we see going on with investors and people that want to put loans on these properties and how they're doing it. So go to oldcapitalconference.com, sign up for our newsletter, and then we'll send you an email or a flyer to let you know to get into our rotation so you can see what's going on in apartment investing in the Dallas-Fort Worth, North Texas area. So again, that's Michael Becker. I'm Paul Peebles. Have a great day.